Welcome everyone to HueFin News. Today is December 19, 2018, the home of the 2-minute price prediction, as well as giving you all the news according to the charts. Now, what we're going to talk about today is the Fed increasing the rate once again, the Federal Reserve rate, and how the market is in turmoil going over that particular news. Guys can see we're going to talk about an article written from CBS News with the title, "The Federal Reserve Hikes Interest Rates But Nods to Slowing Growth." So what they're trying to say is that instead of them expecting raising rates 3 times for 2019, they're going to go ahead and do it twice. So it is slightly a little bit dovish, but the market was expecting them to be a lot more dovish than what they have been recently, or at least from what Jerome Powell has stated in his conference. Okay, now I went ahead and highlighted some of the things that kind of makes you question and wonder exactly what do these individuals do. They simply continue to give you forecasts, and they continue to revise those forecasts, which leaves us in a very peculiar situation as to where should you get your information. If you guys have been an avid subscriber or avid viewer of our channel, you already understand and know that we only pay attention to the price charts. So once we look at these 3 indices today and how they reacted to the news in the market, you will tell that the price chart did not seem surprised. And in fact, the price chart still reflected that weakness was already here. Okay, so let's just go ahead and see some of these statements written in this article from CBS, and then we'll go ahead and look at the price chart and show you why the market has already distinguished the fact that the economy is softening and it is getting weaker. Okay, so let's look at this first sentence. The Federal Reserve again raised interest rates, but that might be the last hike for a while. See, that's already a hypothetical question or a statement. How do you understand that this might be? That is a very, very big question that has not even been determined yet. The central bank indicated it would raise rates more slowly in 2019, nodding to signs that the U.S. and global economies are cooling down. The market has already distinguished that fact. I mean, everywhere you turn, we have seen 10%, 20% market corrections. Everywhere you go, there's not a safe haven, seemingly, for your dollars, okay, or whatever foreign currency you may trade or invest with. The U.S. stocks tumbled on the news, with the market analysts saying investors want the Fed to move even slower on rate hikes, lest the central bank, intent on keeping the economy from overheating and stoking inflation, pushing the country into a recession. Now, if we're already down 20% in a bear market, at what point does it make you a recession? I mean, from all-time highs in this particular year, 2018, we have seen 20% drops, in some cases 26% drops in the market for some of these stocks. Okay, I think when you look at the price chart, we may already be entering a recession. Okay, so I don't know at what point makes these so-called analysts, experts, to distinguish between what we've seen recently starting in October to the massive loss we've seen already versus what a recession looked like. By the time the analyst goes ahead and tell you that we are in a recession, it's too late. So that's why you need to pay attention to what the price chart is reflecting, and that is it. Okay, I will leave a link to this article in our description box if you guys want to read up on it. But obviously, it continues to show you that even the experts, even those who are in authoritative roles, continue to revise and estimate and change their projections. So, and I only say that because of this particular statement here. The Fed now projects that the U.S. economy will expand 3% this year, down a hair from its September forecast. So here we are in December, and they're going to go ahead and revise their projection on growth from 3%, from 3.1% to 3%. Now, is still forecasting a solid growth of 2.3% in 2019, but that is lower from that 2.5% that they predicted in September. So this is that earlier portion of this article to where they was talking about that they're seeing the US economy cooling down. So they only nudged down their growth prospects, maybe what, 0.2%, and that's it. But considering what the market has been reacting to since the month of October already shows you that we are in a weakness. Okay, we're definitely seeing a weakness occurring in these stocks, in these indices. So this again expect to be revised even lower as we go throughout 2019. Now, I'm not going to waste your time on the article. I just want to show you that these three indices, the NASDAQ, the S&P 500, as well as the Dow, has already shown you that the market experts, those who participate in this arena every day, has already seen this occurring. Okay, this is the daily price chart. You guys can tell here, even looking at the NASDAQ, that we did see an increase to the upside today in this space. But for us to close towards the low of the bar, and we couldn't even break 6,500 points to the upside, it tells you that we're still in weakness. So still expect the NASDAQ to continue to move to the downside in price. We already came and hit support areas, but again, I still expect these indices, stocks, to continue to move lower in price. We might hit the low of this particular day, which was around the 13th of February 2018. So literally it took us about a whole year to get all the way up to all-time highs in the space, and less than 3 months to get right back to where we started for January 2018. That is how fast we have diminished our increases in price that we've seen for 2018. Okay, so the NASDAQ has already been showing you that the market was in a correction, bear market, whatever the case you all may want to call it. But either way it goes, the market is still forecasting movement to the downside because it is still uncertain, and it is seeing that the market, the global economy, has more surprises to go through. Okay, same thing for the S&P 500. You can tell that we couldn't even break above our support line in the market for the S&P 500, and then we closed toward the low of the bar as well. So try to zoom out a little bit, and you can tell that that 25-50 point area was literally a very good area of support, and we're all the way down here at 2,500 points. So now, even if we were to see the S&P 500 to move to the upside, 25.50 in around that price is going to be a resistance area. So continue to zoom out for the S&P 500. Literally, we have a lot of places to where the S&P 500 can find support. Right now, with this massive swift move to the downside, we haven't found any location to where the market participants are coming in and buying. Not yet. Okay, so we still have some downside movement to go with in the S&P 500 too. We have not found the bottom yet. We're still expecting this particular indice to move to the downside as well. Okay, another quick look at the US Dow, or the Dow. Again, this is another indication to where the market hit our resistance area and it got rejected. That is still more confirmation that weaknesses here, and that the market is still going to continue to move lower. As a matter of fact, we even broke to the downside of that 23,600 point. That was an area of support back in April 2018. If we are to recover or move to the upside, that now is going to be the resistance area. So that area is going to have to take a lot of volume and a very good indication of a strength bar in order for us to break above it. As of right now, the market is not reflecting that point, and the movement to the downside looks like it's still in tow. Okay, so we might just come right back here, like I said, in the NASDAQ, to where the market came and hit a very substantial low in the beginning half of February. Okay, so that can be support, but again, until we're able to see the market come in and uphold the areas for these three indices, the movement to the downside is still intact. Okay, so that is just our analysis. That is what the Fed is trying to do to the economy. They're trying to make sure that it's stable. They're not trying to overheat it to where inflation is going to instill to push the global economy, the US economy, into a global recession or even a depression. So they're trying to put their foot off the brakes somewhat. But if the market continues to deteriorate like we've seen ever since the beginning half of October, then I would expect that they won't even raise rates at all for 2019. We will have to see how the first quarter of 2019 actually pans out. And if it actually looks a lot dreary and gloomy than what we're actually noticing currently, then definitely they will not be raising rates at all for 2019. Concerning the fact that they allow this to happen in the stock market kind of shows you that they are behind the curve. Okay, that's another thing I wanted to show you, that one of the Frances Donald, she's an economist for the Canadian asset manager Gaston, I don't know how to pronounce that, so I'm not even going to try it, in Toronto. Okay, this is what she said. The market turned dovish several months ago. She's talking about in October, and is waiting for the Fed to catch up. The market definitely is ahead of the game while the Fed is behind the game. We still have a very large gap between what the Fed says is going to happen and what the market thinks is going to happen. So the Fed is expecting one thing, the market is expecting another. The Fed is expecting growth to continue in 2019, and by looking at these price charts and all the other indices and sectors of the US equity market, already shows you that they're not expecting growth to be reflected for 2019. So definitely the Fed is behind the curve. You all need to keep your eyes on the price charts, because this definitely is always above the game, before the game, and ahead of the game. That's why we solely focus only on price charts and not articles, videos, or anything else, because those things are reactionary while the price chart is proactive. Okay, so give us your thoughts, give us your comments about what Jerome Powell did today, raising interest rates. Do you think that's going to be detrimental? Do you think it's going to be positive? We definitely like to give you all the opportunity to voice your concern about the recent market action. So leave us a comment in the comment section of this video, and make sure you all maintain your profitability, and make sure you like and share this content as well, because this is how you're able to make sure that you're ahead of the game.